The whole point of tonight is to try and get some insights into what's going on in our gold industry. A lot of you investors, a lot of you perhaps looked at the industry and think, how do I get in? You've got three of the industry leaders here. I'm going to ask them some questions about some of the challenges we face, how they run their businesses, what can we expect in the future. But if you have any questions, please, and I will be asking after a little while, please put your hand up and when I ask, and ask some questions. And you can ask specific questions of a company or general questions to the panel about the way the industry's run. I'm going to start off by asking each of them just for 5 minutes to run through what's happened in the last year since we gathered here, what highlights and maybe lowlights they can tell us about. So, Sean, would you like to take that away, please?
Sure. Thank you, Paul, and thank Paul for doing this once again. We really appreciate it. Last year, as Paul mentioned, Agnico produced almost 1.7 million ounces of gold, and we've been on a bit of a growth trajectory since 2011. We were producing about 1 million ounces. So the way we looked at the last several years is we didn't see it as a time to sort of hold back. We actually saw it as a time to invest in the business, increase our drilling programs, invest in juniors, buy assets, add skills. And as a result, that put us in a position to make some important decisions through 2016 and early 2017, where we've done a lot of analysis on our Nunavut platform and have made a decision to invest $1.2 billion over the next few years building and expanding that platform. And we just find it a great place to work. We've been there for 10 years. We find it a place that will sort of match well with what we're doing in Quebec, where we've operated for 40 years, and we see ourselves in a position where we can do business in Nunavut for multi-decades. And that's the way we set up our business. We set it up in a way where we don't want to be everywhere, but in those places where we choose to be, we look to become a dominant player over time, and we found that that's the best way to create value on a per-share basis, is bring skills into a region with a lot of geological potential and work those consistently over time. And I think one of the things that we've continued to do, including 2016, is continue to invest in the future of our business. And a lot of the resource space gets themselves into challenging times because they overinvest when things are going well, and they panic and underinvest when things are not going particularly well, particularly with the gold price. So again, consistent investment over time that's positioned us now to take that next step, and by 2020, we'll still have the same number of mines, but we'll be producing over 2 million ounces.
Great, Peter.
Well, we haven't existed for the number of years that Agnico's existed, but we admire, in many ways, the way that Agnico has been managed and developed over the course of that 60 years. We've existed since 2003, and if I can be as candid as possible, we've been somewhat erratic, certainly from the point of view of developing new assets. We've done an excellent job on some and not so good a job on some others that needed repair. Someone recently described it as a venture capital model versus a private equity model. And part of what we've tried to do is to create sustainability, predictability, become more of a private equity type model. In my view, and if I can be as complimentary as possible to Sean and to his predecessors, very similar to what Agnico has done over the course of many decades. In 2015 and 2016, we embarked on a path of creating that predictability and that reliability. We said size may matter in some cases, it doesn't matter in all cases. We don't want to have 10 mines or 11 mines. We're very comfortable in a range of 6 to 8 mines. So we need to rationalize the portfolio. So in 2016, we embarked on that path. We also looked at it and said we want, in order to have predictability, better mine plans. That implies that we may be getting less production, but at better costs, with an emphasis on cash flow and free cash flow from each of the operations. We want to spend money on exploration. And we want to spend money on exploration in particular at our existing operations where we know we've got more areas of mineralization. We want to bring that to ore. We want to bring that to resources, proven and probable reserves. In the last couple of years, and it was punctuated in 2016, Paul, we also completed the picture by saying we also need to develop a quality of management that can best manage those assets. A startup operation, in 2003, we had one small producing mine of 84,000 ounces per year. And we've matured quickly in that period of roughly 10 years to 12 years with acquisition growth, organic growth, and a mix and match of the two. And now we looked at it, I personally looked at it, and came to the conclusion that we needed a reliable management, high quality, strong, great bench strength, and making sure also that we have key performance indicators that are properly aligned from a mine all the way up to corporate office and all the way back down from corporate office to the mine. And so we undertook that path. We promoted one of our own here, Daniel Racine, into the role of Chief Operations Officer. We divided ourselves between a North and South Division. We said we want to be focused in 4 jurisdictions in which we operate. They're high-quality mining jurisdictions of Canada, Brazil, Argentina, and Chile. We want to rationalize the portfolio. If something is too small, requires too much of our time, it may have value, but it's best if we pursue the larger scale operations where we can deliver the better value. We spent money on exploration, and by the end of the year, we had said these are the discoveries that we've made at our Chapada mine, our Minera Florida mine, at Guacamayo in Argentina, Canadian Malartic with the Odyssey discovery and how we've matured that. At almost all of our operations, we demonstrated these discoveries, what it represented from drill intersections, and what that implied to us in terms of resources and reserves. So coming into 2017 now, we have the management construct in place. We've rationalized the portfolio to 6 producing mines, soon to be 7 with our Cerro Moro mine. We improved our mine plans. We downscaled our production as a result of that. We produced 1.26 roughly million ounces last year, 116 million pounds of copper, and about 7 million ounces of silver. We brought that to a better level with 6 mines, not 9 mines. We segregated the remaining 4 if we count a development stage project, into a separate division called Brio Gold, and then we spun it out publicly. We still have a controlling stake in it. And with the improvements to balance sheet, the improvements to mine plans, the improvements to our management and the management construct, we enter into 2017 with a far more sustainable platform and with a high growth prospect coming from a smaller platform, but a higher growth. Let me conclude by saying that an important aspect of 2017 that continues from 2016 is the development of our Cerro Moro mine in Argentina. Now, Cerro Moro is a very rich, high-grade operation, 1,000 tons a day that delivers 130,000 ounces of gold and 9 million ounces of silver. But it does all of that at an all-in cost of roughly $7.50 for silver and $600 for gold on an all-in cash cost basis. So this is a step change in terms of improvement to EBITDA, improvement to cash flow. We see this operation as increasing our cash flow by a full 1/3 from that operation alone. So a smaller company, but focused on larger production at better costs from each of our operations.
Okay, thanks. Mick, coming to you. Now, for those of you who don't know, you may have seen Diane Garrett up here in the past with Romerco and the Hale project in the Carolinas. OceanaGold, it was about 15 months ago you completed the acquisition?
19 months ago.
19 months ago. OceanaGold completed the acquisition of that project. So presumably in last year you've been working hard on that one.
Yes, it's been an exciting time for us, Paul, and let me first say thank you to Patrick Michaels for organising this event. It's my first visit. Thank you for the invitation, and it's such a great spectacle. I really appreciate being here. Thanks for that. We did have a very big year in 2016. We acquired the Romerco and the Hale asset in September, the end of September 2015, and we set about constructing the project. And I'm proud to say that we've now finished construction. We've finished or almost finished commissioning, and we're about to announce commercial production for the only gold mine on the east coast of the US. And in fact, it's interesting, and you talk to people in the US about where the first gold rush was in the United States. It was actually in the Carolinas, in North Carolina and South Carolina, in 1796, 50 years before the California gold rush. So we've now got a world-class asset in a great jurisdiction with low-cost production, with enormous exploration potential in a district in the Carolinas which is really unexplored. It's a fantastic project. It's been a fantastic development for our company, and part of, I guess, a significant milestone in the evolution of the company, which we set a course about 6 years ago when we said we wanted to build a multinational mid-tier gold mining company of choice, operating in Australasia, Southeast Asia and the Americas. And we were successful, obviously, with some investments in the Americas. But really it all started in New Zealand. We are the largest gold miner, pretty much the only gold miner in New Zealand. We've been there for 26 years. We've produced over 4 million ounces during that time. Right through the 90s, when gold price was $250 to $300 per ounce, the Macraes mine was continued to operate, albeit very slender margins. But it's built a DNA in the business of people who really know how to extract value out of gold mines. So it's that DNA, that expertise, the depth of management that we started with and developed, or have developed from our New Zealand operations, that's allowed us to springboard firstly into the Philippines with the development and operation of Didipio, which has now been operating for 4 years and has produced $500 million of free cash flow to Oceana shareholders in those 4 years. So it's been an outstanding asset for us. And that's allowed us to purchase another mine in New Zealand called Waihi, which we purchased from Newmont in 2015 for $100 million, and we've paid that off. And that continues with enormous exploration potential. And then, of course, the Hale development. So we're on a journey. We too would like to grow further. We would like to grow from our base in Australasia and North America to further diversify the business, both technically from a production risk perspective and also geopolitically, to minimise the uncertainties that always occur in our business. So that's our plan. We're on the way. We're heading upwards, and we're going okay. Thanks, Paul.
Thank you. Okay, with that sort of introduction in each company, I just want to turn to some industry issues now. We may see a start of an M&A activity again. We saw last week a little bit of frenzy from Goldcorp purchasing Exeter Resources and purchasing 50% of the Sirikasali project in Chile. So 2 big copper gold projects. And you guys have all been involved to a lesser or greater degree, in fact, in corporate activity. Last week, Sean, you raised some money. You had a new shareholder come in. We'll perhaps give you a chance to talk, because that's very interesting. We'll perhaps talk about that in a minute. So you've added to your treasury. Peter, you sold Mercedes last year, and you've got Sierra Morro building, as you said. And of course, as we were saying, Mick, you acquired Hale. So from each of your perspectives, where do you see the best opportunities in the industry? I mean, is it early stage projects, or is it buying production assets? And it's obviously going to be tailored to what your strategy is, but is it a time for building production, or is it for building an exploration pipeline? Who'd like to pick it up? I'm not going to force it on anyone first off.
Well, I'll have a crack. It's fair to say that the value of stocks, the value of projects and assets is risen in the past 12 months. Certainly when we purchased Ramaco, it was arguably the bottom of the market. And since then we've seen a lot more buoyancy in the gold market. And the quality of acquisitions has dried up to some extent. Certainly for operations, you don't see the majors selling their assets any longer, or so to fix up their balance sheet. And in those times when you're seeing fairly full prices for assets, it's a good time to use the drill bit. So you need to get out there and explore and find more gold. It's the cheapest gold you'll find in this environment. And so you have to have good ground. and you've got to spend the money and get the best geologists and spend the money, seriously spend the money for a continued and long period of time, systematically exploring and increasing, first replacing and increasing your reserve base. So my view in this market is we have to invest in exploration. I think that there has been a dearth, a shortage of investment in exploration over the past, certainly the past 4 years, but I would argue over the past 20 years. And we're seeing shrinking global opportunities for increased reserves, and it's driven by the lack of exploration funding. I know that's certainly the case in Australia, where you've got the second largest gold producer in the world, and there has been virtually no discoveries of any significance for about 12 years. So that's my
It's
view.
not just a question of funding, though, is it? It's because up until 4 years ago, there was a lot of funding, but they weren't finding. We haven't had any real big deposits, certainly in the gold industry, found in many years. The elephants that we talk about. So,
Well, yeah, funding by mining companies and funding by the investment market to raise that. So, yeah.
You're asking a question about industry, but also specific to a company. I would say that in the industry, without taking a position on whether or not it's a good or a bad deal, I have my own personal views on the deal that was done in the Marrone district in Chile. I don't mind sharing with the people in this audience that I think actually it's a good deal. That's my personal view, notwithstanding the market reaction. But I think what we'll see...
good deal for Goldcorp?
I think it's a good deal for Goldcorp. I
Why?
think it's a consolidation of the Marrone district. It's more than 20 million ounces. It may not be a good deal immediately if the only focus in the industry is free cash flow and only the generation of free cash flow. But this is an industry with depleting assets. And so you have to replenish those depleting assets. And if the motivation for that deal was to say we are going to create that next wave of growth, it may take us 2 years, 5 years, some period of time that is longer than that, then I think that should be applauded, because I think that at the end of the day, it is about the replaceability of ounces, either by discovery or by acquisition. And that district is a very prospective district, and if you can create synergies in that district, I think that creates an excellent opportunity. But what I think we'll see in the industry is more of the strategic, perhaps creative type deals, perhaps similar to the deal that we did in the acquisition of Canadian Malartic, of Osisko in 2014. What I think we will likely see is more joint venture type relationships in the industry. Where I see opportunity for consolidations, however, is not in the top tier as much as it is in the mid tier. We have a 70% interest in a company called Brio Gold. I think that is that tier 2 stage of companies, somewhere in the range of 100,000 to 400,000 ounces per year, is ripe for plucking, and an excellent opportunity for the creation of improved multiples. And we've seen some of that. We've seen that with recent deals that have been done, some of which were criticized, but that did well from a market point of view. One that comes to mind is Kirkland Lake Gold, a company that has gone from a 0.5 time net asset value multiple to 1.25 times or 1.3 times, should be applauded. I think those are the types of deals that we'll probably see, and the deals that can be done. And that mid-tier space likely needs some consolidation. From Yamana's point of view, and I'll pick up on something that you had mentioned, we've been focused entirely on organic growth. Our acquisition days are not behind us. I think we should never say never. But we deliberately set out to acquire Osisko in 2014 because of the organic opportunities that were already in the company and that were represented by that acquisition. And so we're focused on organic growth, and a significant part of that, it's not just the development of Cerro Moro, which is now roughly 9 months away to completion, but it's also the discovery of new ounces. And our focus in the last 2 years has been on exploration. Roughly 80% to 85% of our exploration budget has been at existing operations where we identified new ore bodies, and we've now been maturing those, that we expect this year to bring those to resources and then to proven and probable reserves. So our focus is organic growth, certainly in the next couple of years. I know that Greg, who runs our business development, is probably cringing at this point and thinking, why does Peter say that all the time? But the reality is that I see that organic growth is the way forward for our company, But I do see some consolidation occurring in the mid-tier space and more creative type or strategic type deals in the larger cap space.
Sean, you've been doing a lot of exploration, but you've also been acquiring junior companies for their exploration potential. Would you like to just explain the strategy there?
Yeah, I think we've perfected that. We've got 2 of our 8 mines now were investments we made back in the 1970s. So it's something we've done for decades. And for us, that's still the way forward. But I think the backdrop from an industry perspective is declining reserves, declining production profiles among many of our peers. So the business is getting a lot more difficult. And the opportunity set is shrinking. There are too many companies in the industry for the number of quality opportunities that will allow these businesses to actually improve and get better over time. So it's going to be a challenge for companies to build per share value, which means they have to be focused. And they have to be focused on what they do well and not get caught up in an idea that you need to constantly do deals. But there are also companies that will simply be pressured to do things. And so there will be deals done. Hopefully, for the industry's sake, they will be smart deals. So I would see activity here. For us, we're still focused on the early stage, but what we've been forced to do over the last few years is go even earlier than we otherwise would have gone, to try to identify these things based on our team who have been working together and with us for over 25 years to understand the geologic potential. And if you look at our track record of building net asset value per share among our North American peers, we have the standout performance in the last 10 years. And isn't that interesting? 10 years ago is when we bought our interest in Kittila, followed by Meadowbank, followed by Meliadine, followed by Pinos Altos, La India. And those were all those earlier stage opportunities where our team said, geologically these will grow, and the technical risks we understand and we can manage. It's not as easy to do that anymore, so we're having to take earlier bets, and we'll continue to do that. But there is a limit to that, and what we've had to do with our team is say, well, even though we've looked at more things, you can't just continually add to that portfolio. If you've got something that you like, then take something out. And so if you look at our track record, there are times when others have put up a number to buy something. We had 4.9% of Remarco, and the bid was made, and we said, you know what, we got it at 30-some cents, and that's a fair price, we thought, and we'll sell into that bid. We had Probe Mines. We put $11 million in, and Goldcorp made a bid, and we made $42 million on the 11. So sometimes that portfolio turns over, but I think it's the process of getting your teams out into the field, working with the junior companies who are doing a lot of the legwork, and not just putting money up. You have to actually become their partner, and you have to actually work with them and help them move those opportunities forward, and then you're going to get good M&A and smart M&A. But the arithmetic is working against the juniors because there may be 20 potential buyers, and there's hundreds and hundreds and hundreds of stories out there. And so we can't buy everything. We don't want to buy everything. But we will be focused on those companies, I think all of us, where we see that geological upside, because then you can deal with technical issues. So I think that's still the way forward. It's getting a lot tougher, though.
It's perhaps not obvious to shareholders when the likes of these 3 companies do exploration, because you don't get an immediate return on it. It's a longer-term thing for you guys. Whereas for a junior, and I'm just trying to explain this to some of the private investors here who perhaps don't quite understand what the difference between a junior exploration and a fully fledged gold producer. The exploration companies, if they drill a hole, they'll probably get a re-rating in the market, sometimes 10 times. But for a company like the 3 here, they're doing exploration for the long term to rebuild reserves, and they're not going to see one drill hole make a difference to their share price. So if you're investing in any of these companies, that's something you have to be aware of. Okay, yeah, and reserves are certainly, I think one of you mentioned that reserves are certainly declining. Metals Focus did a report recently, and they reckon that all the senior gold producers, their reserves have dropped from 17 years worth to 10 years worth, and that's all that's in the ground, because they've been looking at cutting costs, and it's easier to cut exploration. Mick was saying the exploration has been down, so that's one reason, but which should be a concern to all of us, because if that's all that's out there, and finding new gold is more and more difficult each day. Gold price is around $1,200, $1,250 at the moment. To each of you in turn, are you running your companies based on that sort of price? Or to put it another way, if the gold price went to, say, $900, would you run your company in a different way?
Paul, I struggle with this question. I struggle with it because gold is not going to $900 an ounce. I struggle when people say, what if it goes to $1,000 an ounce? It's not going to $1,000 an ounce. We've seen the worst of what could happen to the gold price from 2013, and the worst is behind us, and the worst was not $1,000 an ounce.
You notice I didn't ask you directly where do you think the gold price is going,
yes,
given my joke at the beginning.
Yes, I know. and my IQ is no higher than what you suggested, so I'm not going to try to predict gold price. But I think it's important to lay that out there. We cannot look at gold price independently of every other input that is out there, and we have to look at it geopolitically, socioeconomically, and come to firm conclusions and some conviction on what happens with gold price. But if gold price were to go to $1,000 an ounce, then what happens to local currencies? What happens to the Canadian dollar, to the Brazilian reais, to the Argentine peso, to the Chilean peso in our case? When 75% to 85% of our cost structure is locally denominated, that will have a significant impact to the cost structure, and so that would imply that we may be able to preserve those margins at $1,000 gold by comparison to $1,200 gold. So it's far more complex than saying what happens to gold price if it goes to $1,000 an ounce, which I don't believe it will. Indeed, I think that the trajectory is upside rather than downside. But I think the best way to manage a business is to say, take the spot price, conduct sensitivities at lower gold prices, and then lower it further to determine what you would do in those environments and make certain assumptions on what you think will change on your inputs. And that's the best way, I think, to manage a gold price. But would anything change in terms of how we're managing the business? Would we be mining differently? Would we change mining methods? Would we explore less? The answer to that is in my view, a firm no. That's the mistake that we would be making. And on the conviction side, and why I say this, is that we also have to look at it and say, well, how long is it at $1,000 an ounce or $900 an ounce? If it touches that number, stays there for several months, you should never change your plans. And so it would be difficult to say that we would overhaul the entire business. What we would do is we would say, let's look at how we improve those cost inputs today so that we can manage that business if gold should go temporarily to a lower level. But equally, the flip side of that is don't change what you're doing if gold price goes to, when gold price goes to $1,500 an ounce or $1,800 an ounce. Just absorb those margins that have been improved, take that cash flow and free cash flow and make it available to your shareholders.
Thank you. Good. Mick, got any comments on that?
Okay. There's a good lesson in business that expect the unexpected. And if you think gold price is going to take off, then you should be prepared for it not to. And the best way to protect yourself against the gold price, or something we can't control, is to manage the things you can control. So you have to drive yourself down the cost curve. You have to have low costs of production. And in my 30-something years experience as an engineer working in the industry, and is that as a chief mining engineer of Mount Isa Mines taught me in 1985, he'd been in the business for like 35 years at the time, and he said that, Mick, there are three things that are important in this world, in the mining game: grade, grade, and grade. And it's true. It's almost as simple as that. You have to invest in high-quality assets. You have to sweat them. You have to get the best people to operate them and drive yourself down the cost curve. And that way, as we have done, we're in the fortunate position now where I don't have to worry about the gold price. I'm agnostic to the gold price. If the gold price goes up, we make more money. If the gold price goes down, there are more opportunities because others are struggling. And there are more opportunities in the M&A space. So for me, we wouldn't change our business model. We would continue to drive our costs down. But there's one more thing I would add, and that our philosophy is that every operation has to be cash flow positive. No one operation should subsidise another in the same business. And we've got one operation in New Zealand called Macraes, which is a relatively high-cost business. And in our industry, we use the code leverage to the gold price. It's got lots of leverage to the gold price. But what we did when the gold price tanked $200 an ounce in 2013, about this time, around the Zurich Gold Forum, when we were all panicking where gold was going, we had to change mine plans within weeks. We had to, and we put in some collars, hedging collars, to ensure that that relatively high-cost business that had lots of leverage to the gold price could stay cash flow positive. And that was gave enormous comfort to our shareholders at the time, because we'd just opened a very high-margin business in the Philippines, and they didn't want to see that cash leaking out the back door in New Zealand. So I think that's an important principle in when you're running a business, that every mine have to be making cash. But really, the answer to the gold price conundrum is get yourself down the cost curve and manage what you can control.
Yeah, I would agree. I would add to that. I guess one of the advantages of having a 60-year operating history, and I've been here 32 years, is we've kind of seen it all. And as CEO, I've seen $300 gold without a hedge book. We were the only guys not selling forward, and we were delivering into the spot price. And we found that we were able to continue to move our business forward and still make some investments in the future, because we were always well positioned to deal with that low gold price environment, because we had a simple story, a simple set of assets we knew well, and a management team that fit those assets. So when we look back at 2011, when gold fell dramatically, that subsequent 5 or 6 year period, our output actually grew 60%. So it was more about positioning going in. And we even go back to November 2015, gold was $1,050, we forget. And when gold's $1,050, everybody is thinking 900, even though it may never get there. And so the challenge is to walk that fine line where you literally cannot turn the tap off of future investment. Because if you do that, you're going to lose your best people. They won't stick around. You're going to put projects at a disadvantage, and you can't go stop and start in this business. So for us, we've been fortunate that going into these down periods, we've had a strong position going in, and we always say when we're in that trough, it's actually the best time to be buying the right things, because really it's about who's best positioned when the turn comes. And if your competition is still tidying up and deconstructing and haven't fixed things, then you're going to be way, way ahead of them when the turn comes. So it's really about, the businesses you own to make sure they're properly positioned for the ups and the downs.
Thank you. Do we have any questions from the audience? I know the beef is probably very tasty, but if you could... Yes, would you mind just waiting for the microphone there, behind you? There it is. Thank you.
Thanks very much. I think it's a question generally to the panel. How leveraged do you think the industry is right now compared to past cycles? I mean, overall financial leverage. How much money have people borrowed, do you think? What do balance sheets look like? Because that's often a good indicator of where we really are in the cycle. What do you think?
They're certainly a lot better than they were, and I think a lot of the businesses over the last few years found themselves with a few things. Businesses that were maybe too big for the opportunity set, businesses that had become overly complex during a growth phase and as a result had to be deconstructed, companies that had way too much financial risk. And I would say one thing, we're still here after 60 years because I think we manage financial risk pretty well, and a lot of competitors have come and gone. But a lot of companies have done some heavy lifting. They've shed non-core assets. They've applied those proceeds to improving their financial flexibility. And I think generally they become more disciplined. So I think that's important, because I think gold's going to actually do pretty well over the next few years. And I think as a whole, the industry has done a better job positioning now for that upswing. Some still have more work to do than others, but I think on balance, there's been some good work done.
Yeah, I would echo that. I agree with that. I would add, however, that we are in a period where there is more leverage on gold in gold companies en bloc as an aggregate that we've seen in prior cycles. In the 90s, I think it would be almost unheard of to have that type of leverage in a company. One might have project debt, but not corporate debt. But I share what Sean has said, that over the course of the last 3 or 4 years, there have been significant improvements, significant repair to balance sheets. And so the leverage issue is now behind the industry, and it's behind the individual companies in the industry. I think there can still be improvement with specific companies, but now we're into the minutiae, the smaller points. The heavy lifting has already been done.
Yeah, similarly, it's very obvious that, you know, the large companies in particular in the gold space, a lot of them were over-leveraged, borrowed too much money, had to sell assets over the last few years and to fix their balance sheet. You know, we are, the gold industry, we're price takers, right? We don't determine the price we get for our product. And from a purely business perspective, you can't run a high leverage model where you can't set the price and you don't have, you know, you've got a lot of uncertainty about the revenue stream. So you have to run in a business, you know, if you're going to run it as a business, you have to run a low leverage model. And I think, you know, the industry has learnt that lesson over the last few years. Let's hope it sticks around for the long term, because if it comes back, we're going to see, you know, a loss of trust from the share market, from the equity holders, where companies are borrowing money. You know, I've got this great saying where a few years ago, I won't say which bank it was, but I was in a meeting with their investment banker and the other guy, and he said, "Oh, Mick, this is John. He's my high yield banker." And I said, I had my CFO next to me, and I said, "Hi, John, meet my low-yield manager." So, you know, it sent a very clear signal to the banks that, you know, these long-dated bonds with really high yields are easy to get. It's easy money. They're throwing it at you. You know, it's lazy money, and it's not good for the business just to be tempted with that sort of thing. So. Yeah.
Okay. We have another question here. Oh, sorry, we have a prior one at the back there. I'll come to you next.
Thank you. Yeah, question to the panel concerning supply demand of silver and copper. We all are bullish on gold, that's for sure. We all love to see that around the neck or the wrist of a beautiful woman and are down in the cellar maybe for insurance reasons. But let's come to the real world. How do you guys see and percept? For example, China is putting a $100 billion solar panel program now in place this year, which will suck up a lot of silver and copper. And also, if we go to the e-mobility in the world, the Teslas, the Mercedes, the Audis, etc., will suck up a lot of copper, silver, and other metals. What are your perceptions about deficits in the silver market, deficits in the copper market? There's estimated 500,000 tons for this year. How are you planning on that? Or let's say, what is your perception of that for your company and for the future planning of your production?
Well, as a company that produces gold, silver, and copper, I hope I can speak to that point. As a company that has a significant growth in gold in the next few years, but very significant growth in silver in the next few years, again, I hope I can speak to that. Our silver production in the next 2 years will increase from roughly 5 million ounces, 5.5 million ounces to 14 million ounces once Cerro Moro is in production and its full year in 2019. My view is, for the many reasons that you've given, some of which relate to supply and demand, but also for the the perception that silver still stands as a currency similar to gold. In periods of rising gold price, silver overperforms the gold price. And so if you accept that gold is going higher, then I think you should accept that silver will go higher than gold. So it will overperform gold. If we look at historical ratios between gold and silver, the silver to gold ratio, we are in abnormally high ratios today, and so those ratios will normalize to a level that I think is closer to 50 to 55 times, and that would imply that silver price will overperform gold. So in the last cycle, when we saw gold price go up to almost $2,000 an ounce, we did see that. We saw that the silver to gold to silver ratio had gone from roughly 70 times to 42 times. And that's significant performance. And so I think that will occur if you accept the gold price will go higher. Copper is a bit more difficult for me, I have to confess. I am seeing too much of the point and counterpoint on the supply and demand. Is there a deficit? What's happening with the supply side, the demand side, for me to be able to accurately predict where copper is going. Now, that is not a principal metal of ours, but we do produce roughly 120 million pounds of it. It represents about 14–15% of our cash flow and our revenue. But what I hear in the marketplace with bigger copper producers is that there is a deficit coming in the next several years. I don't believe it's next year. I think it's a few years out. There is growth in supply, growth in demand that will be coming, and so copper price will go higher. The way that I personally look at it, however, is that copper price for certainly the next year to a couple of years will be within a range that is very similar to what we've seen over the course of the last couple of quarters. So somewhere between $2.50 and $2.75 per pound, perhaps as much as $3 per pound. But I don't think we're yet at the point where we'll see $4 or $4.50 per pound. That will happen at some point into the future.
Any other comments on copper or silver?
I'd offer some commentary on copper at least. We don't produce that much silver, and it's not a big byproduct for us, so I won't make any comments on that. But copper is a big revenue earner for us in the Philippines, and I've actually personally been involved with the copper industry most of my career, and I've followed it with great interest. Back in the days in Mount Isa, when we were fighting the copper price going down from year on year from 80 cents to 75 cents to 70 cents, and even in 2001 when we built the Sepon mine in Laos, copper was only 80 cents a pound, and that was just 16 years ago. And then it just took off. With the China boom, it just took off, and you've seen a lot of investment in copper over these past 10 or 15 years, but it still can't keep up. And the copper consumption around the world is something like 20 million tonnes a year. That's a lot of copper. And the growth rate on copper consumption is still 4 or 5%. Now, if you calculate that, that's an Escondida every year, 1 million tonnes a year of new copper supply. And it's very hard to keep up with that level of supply. And what, as Peter pointed out, most of the analysts are forecasting that there is a deficit coming. They've usually been a bit too pessimistic about, or optimistic, I should say, about the consumption, the demand side. So that deficit wave, or that period, is coming. It was 2016, then it was 2017, then it was 2018, and maybe it's 2019. But it is coming. And when it does come, you're going to see copper start to really surge, because I think people have overestimated the decline in the Chinese, or the slowdown in the Chinese economy. People forget that 6% of a very large number is still a very large number. Even though it's not 7%. It's not actually slowing down. The quantums are huge. And China's not going backwards. I mean, it's coming out of the steel age into the electrical age. People are buying washing machines and dryers and putting electricity in their houses, and all that takes copper. So I'm very bullish about copper in the medium term. I think that $2, you won't build a new copper mine in the world for less than $3 a pound. You can't justify it these days. So $3 is going to be the new floor within probably 12 months, and then it'll go up from there.
Okay, thanks. Good answers. I've got one question in the front here, I promised.
There seems to be quite a bit of optimism on the podium for the gold price. And I'm just thinking about Janet Yellen predicting a few more interest rate hikes this year and next year. So my opinion is that there are quite a lot of dangers for a rising gold price. Mr. Boyd, what is your opinion?
Well, it's true that the gold price has had some temporary weakness around expectations on what the Fed's going to do, and as we get close to those periods when the expectation is we're going to have an interest rate rise, we get some weakness. But isn't it interesting how once that happens, the gold price tends to go up? And we would suggest that if you look at the promises that were made in the U.S. During the election, that you simply cannot drive economic growth, in our view, by ripping up trade deals. The most effective way for the U.S. to generate exports and generate growth is to actually have a weaker dollar. So I think it'll be very interesting to see who the new appointments to the Fed are, and it'll be interesting to see how that plays out with interest rate rises. So our expectations are that we will not see a big increase in real interest rates, which ultimately should be good for gold. And we're starting to see more generalist investors come around the space to try to get an understanding and a feel for the industry and the players, and where they should go when investors come back to gold. And I think they will come back.
Anything to add on that? Just fine. Yeah, I think the point is well made, that it's real interest rates we've got to be looking at, and with inflation seemingly taking off, not stupendously, but real interest rates look as though they're going to remain negative, and that's the key to investing at the moment. I think, Patrick, where are you? We've got time for. Where's Patrick gone?
Over there.
One more question. All right.
Yes. Sorry. First, I want to thank you, Patrick, for the invitation. So I'm not in the mining business, but I truly enjoy being among all you guys, because there's something physically going on where you're digging things out of the ground, and that's obviously very astonishing. So obviously I want to concentrate on gold and silver as a store of value, right? I mean, there's commercial metals, which copper, etc., they have all their reason to be around, but you think about gold and silver specifically, and that's obviously the physical age. So my question to the panel, and thanks for being around, is there are things like, and bridging the gap to the digital world, like Ethereum or Bitcoin, and I would love to hear your thoughts about being a store of value going forward, because things are not just in gold mining, are moving from being physically there to something being in the cloud, being something more digital, being more abstract. So I would love to hear your thoughts about what you think about, can Bitcoin, can something which is being somewhere up in the air be a store of value, yes or no?
I think we'll have to have it as a yes and no as well. We could be debating that all night otherwise.
Well, I think the Bitcoin expert was the guy that was here a few years ago dressed all in white. I think he was the expert.
What?
But one point there, on all this complexity that's now presenting itself as options for investors, I think gold stands out more and more. Is something simple that's easily understood and preserves its value. But sorry, Paul.
Just a point on that. I actually introduced that guy a few years ago. And some of you are laughing because you remember that already. And I made a Freudian slip. I had no idea until a friend pointed it out afterwards. I introduced him as an expert on Bitcoin instead of Bitcoin. I haven't lived that one down. But yeah, any other comments on Bitcoins or coins?
You asked for yes or no answers. Yes, it's a store of wealth. I think it's coming. Whether or not it's Bitcoin or something else, I think it is coming. And I think what is an interesting one is something that is electronic, that is, as you say, in the clouds, but that relates to gold, gold production, and gold as a store of wealth. It would create an entirely new market for the investment in and trading of gold.
Yeah, I'm not an expert on the digital world, but I do know that historically gold has been the store of the safe haven for our society for 2,000 or 3,000 years, and I don't think that's going to change anytime soon.
Thanks. We have one more question, and then I think we'll have to wrap up the panel session.
So my question is about political risk. So it's especially maybe on the Philippines, so one from Mick, and maybe also in South America, one for Peter. Just you may tell us one positive example how your company could influence the local or federal government to do a pro-mining decision, and maybe also a negative example where you couldn't do something and why?
Okay.
Right, Mick, over to you.
Thank you very much for that question. I do appreciate it. I have to say, I was at the BMO conference recently, and you know you have 35 meetings in 2 or 3 days, 2.5 days, and each meeting is half an hour, so that's 18 hours of meetings, and I spent 9 hours talking about the Philippines. The same thing over and over again, because it became like daytime television. They're screening it on, streaming it on YouTube, and people know who the secretary is and the president and the different players and who's attacking who, and it just became insane. And with the digital world, everybody knew what was going on. The truth is, in the Philippines, that it's not government policy to eradicate mining. Their policy is to clean up the industry, and I fully support that. And those of us who run responsible mines in any country would fully support that. The curious thing that happened, though, was that President Duterte, who is a fairly colourful Trump-like character himself, who likes to disrupt things, appointed an anti-mining activist to the Ministry of looking after mining. And she has her own agenda, which is really to shut down the industry using her NGO friends that she's worked with over the years. And so she issued, not did she issue suspension orders and closure orders, she just went out, had a press conference. This is following the audit process that they followed. Held a press conference and then just named the companies live on the internet, and I watched my share price drop 20% in 20 minutes, right? You can imagine how that happens. And we had received no formal notification, no pre-warning that this was going to happen. She goes to makes it public, and 2 weeks later we receive a letter from the secretary saying your mine will be suspended for these 4 reasons. One was relating to the potential for an impact on agriculture caused by your mining operations. Well, we could prove that the agricultural industry in the region has actually increased, as it does with any development in these regional centres. And there's a number of other very shallow reasons that were given, but the point was, well, the point is that the reasons that were given were not even the findings of the audit. We passed the audit in flying colours. So what she did was actually illegal, and we've challenged that. We've been through the appeal process, and we've been able to continue to operate without losing 1 hour of operations since this whole saga started. We've been able to produce our gold concentrate. We've been able to ship it to the port. We've been able to get our cash out of the country, which is a clear demonstration that this is not the government acting in a unified way. This is one individual who's usurping power and using her position to further her self-interest against the mining industry. And we're not the only company. There's 28 out of 41 mines in the Philippines that have been put in a similar position. So it has caused quite a stir. I think if I can draw similarities between President Duterte and President Trump, is that they like, before they go into a meeting, they roll a grenade in, it blows up, then they walk in, move the chairs around and they say, right, now let's talk. So what he's done is he's shifted the conversation around mining to the left in the whole process. And at the end of the day, they have a strong government a law around mining, they have good government processes, and those processes are taking effect now. And unfortunately, that doesn't help my shareholders, because they watch the media and they pick up the social media messages as well, which are often inflated. And I hate to say it, but there is a lot of fake news out there. So, and it distorts the truth a lot. We feel very confident that this will pass in the near future. But it is the nature of mining. Wherever you go, you're seeing more and more challenges with political risk. I mean, Freeport's now facing it with the largest copper mine, or second largest copper mine in the world. They're being forced to sell 50% of the mine. This is I think it's a $20 billion asset. It's an enormous operation. They produce more gold as a byproduct than any other gold mine on the planet. That's a big mine. What was the other one? Acacia in Tanzania. They've just been told they can't export their concentrate anymore. Come out of the blue. These things happen in mining. And So I don't know what more to say about it. I hope that answered your question.
He asked about South America?
Sorry?
He asked about South America as well? Yeah. I'd love to be able to take a poll, but everyone's probably getting tired. But I'd love to be able to, by show of hands, to ask how many people think that there is geopolitical risk in England, in Europe? Who predicted Brexit? How many people think that there's geopolitical risk in the United States? Who would have predicted a Trump presidency and the trade issues that are occurring? So we look at geopolitical risk a little bit more sanguinely. And as a mining company, we look at it more from the point of view of not the broad geopolitical issue, but the more narrow what happens to mining. In the 4 jurisdictions in which we operate, Canada, but the 3 countries in South America about which you ask, there's an established mining law. There's established protocol for mining. There are regulations for how one goes about getting an environmental permit and getting an operating license, what one has to do for reclamation, health and safety protocols, what you do with underground mining, the number of hours underground, ventilation requirements, open pit mining. And that's what we like about it. We like it because it's predictable, it's reliable, it's already cast in law. It's already cast in stone, and there are many years of history to mining. If we look at a country like Brazil, and we can't lump South America or Latin America into one bundle. Brazil's had mining going back, at least 500 years, 450 years. It has a pedigree for mining that is at least equivalent to Canada. I'd say the same is true for Chile in terms of its tolerance to mining. And more interestingly, Argentina, which has been very local in terms of where you would want to be mining, province by province, very similar perhaps to the United States or to Canada, where some provinces are better than other provinces. For the first time ever, we have a presidency in the country that is saying we are not only tolerant of mining, but we are entering into a mining agreement with all of the provinces that says this is the protocol to follow. We will make it voluntary on each of the provinces to join. You will have to sign it, otherwise there are no transfer payments. But when you have signed it, then you have agreed that these are the terms of reference for mining. So it makes it national. But more interestingly, it's a presidency, a full administration that is now saying, look, we think mining is important. And if you've got big elephant country for gold deposits and copper gold deposits that are the equivalent of what is in Chile, why shouldn't they be exploited? So we think that this is a very positive statement for what's happening, even in a country like Argentina, where in some places there hasn't been as much tolerance to mining.
Okay, thanks. Anything you want to? No. Ladies and gentlemen, thank you. Sorry, we have to call it an evening now, but thank you very much for asking some questions and your attention. Will you please thank our speakers?